we've got some traders saying that we're unlikely to see the market fall beyond 4,000, that bargain hunters will become active, but we're sitting pretty close to that point as well. So what kind of role do you see psychological levels playing at this stage of the game?
At this moment, I think 4,000 is a level that I'm not holding on to. The momentum is entirely to the downside. It trades very poorly on technicals. We've looked through the 5.4% expansion rate last year. We've looked through some very good banking results, and the market continues to trade to the downside. I'm not holding onto 4,000 as a level of support. I think we'll probably trade through that, given the momentum we're currently seeing.
Having said that, as I was saying earlier, a huge chunk of that sell-off is being attributed to the foreign investor who's been selling pretty aggressively. One can only assume that it does present some buying opportunity. So what are some of the more lucrative bets that can be taken right now?
Absolutely. I mean, one can see that foreign investors have been on the sell side by the fact that East African breweries and Safaricom are both very close to 6-month lows. And those are the big blue chip counters that most foreign investors reach for. As you correctly noted, they've been on the sell side. I think that's a function of what we've seen. Egypt has been shut for 26 days. Tunisia is down 16%. A lot of these guys look at Africa as a whole. They don't really differentiate between east, west, south, and north. And they're finding they're having to raise liquidity, which is putting them on the sell side. Other issues around this market are, of course, political risk. We had this big announcement this morning that the ICC is going to summons the Ocampo 6. And I think there was some nervousness in this market from the political side, wondering how it would play out. If we get a clean incision and due process, which I expect we'll get, then I think it does look a little bit oversold. But at the moment, the momentum remains to the downside. There's plenty of value around. We got companies on price earnings ratios of 7 and 8, growing at 50% in 2010. But I think for now, the watchword is caution. And the IPO pipeline, of which people have got a little bit feisty about, looks to me dead in the water right now.
Of course, we've got political uncertainty, as you've highlighted, the one factor to consider. The other is the actual spike that we've seen in oil prices and, what this in turn will spell for growth momentum on an economic basis over in the country. How are you reading that scenario?
Oil is an enormous risk. I think, everyone's focused on Libya, but the big elephant in the room is Saudi Arabia. We got problems starting on Friday with various marches, the Day of Rage. And I think, there's a narrative fallacy in existence across global markets that somehow Saudi Arabia is a rock. I don't think it is. I think an 85-year-old king who was away for 90 days is the least qualified to deal with the 21st century. And I think oil risks all point to the upside. I know we've been down over the last 2 sessions on some OPEC talk, but that puts tremendous pressure on the shilling because we import all our fuel. A 25% increase in the last 4 weeks in the fuel price is absolutely killing the shilling. And the shilling looks very, very fragile right now at this 17-year low. And on the charts, it looks as if it could fall 20% if we break 84 on my chart analysis. So as you point out, that's a severe risk. The other risk is meteorology. The Kenya Meteorological Department is talking about rains being between 20 to 40% less in this rainy season. That's going to spike our food prices. It's going to put a lot of pressure at the bottom of the pyramid. And one's got to ask whether our government has been focused on these twin issues, or have they been more focused on the political issue?
Aly Khan, I know that I touched on manufacturing stocks in particular, which are expected to come under pressure as a result of these higher prices, the likes of Bamburi, East African cables as well. But yesterday, I came across commentary that industrial stocks that do not have much of an international supply chain will be in vogue. The likes of Mumias Sugar, KPLC as well. So it seems like that there is some distinction to be made. I'm just not sure of the extent, though.
Well, I understand the point that you're making, but I think, what that commentator seems to me to be saying is that there are some counters in the industrial sector which have a locked-in local market and really are not sensitive to international supply and demand dynamics. Mumias Sugar, which you raise, is just a fraction of a 52-week low. First half results were very poorly received, as you can see by the price action. You know, the sugar prices have rallied up about 40% in a period where they essentially lost 22% against the previous year's comparison. So something like Mumias, I'm not so keen on, because I think, you know, that discrepancy is way too wide between the sugar price and their performance. Other than that, KPLC, which you raised, the clever thing KPLC did, and KCB, is bag their rights money last year ahead of this rather fragile market we're looking at now. KPLC is a relatively simple game. It's about scale up and it's about plugging people in. It's about execution, so you're betting on they've got the money now, you're betting on efficient execution. I think that's a relatively well-adjusted bet. I think you're going to get that share price a little bit cheaper, because I think there are lots of shares in the system which could pop up at any moment. But I, for one, think the banks are a place to play at. You've got some cheap PE ratios, Barclays, KCB, 8.4, 8. You've got some of these mid-cap banks which are growing at great speed and got regional franchises, and they're around 10. So from a risk-adjusted point of view, I think I'd stick around the banks, maybe pick up some agriculturals, and then some of these stocks which are oversold, like Safaricom, around 390.
Having said that, Aly Khan, I mean, given that we are approaching the elections, most of corporate Kenya is expected to adopt a wait-and-see approach before they go and borrow for expansion on the one hand. Impact on banks, where we've seen stellar reports coming through, possibly Standard Chartered, the lone disappointment within that banking segment.
I think you're absolutely right. The banks have done very well last year. They also had a one-way bet in the bond market, and that one-way bet looks as if its time is up because of the local inflation rate, which is being taken off. So there are concerns that the banks are not in the sweet spot that they were last year. They're not going to have these outstanding gains. KCB grew 50%, Barclays nearly 20% organic growth, then they took in that one-off gain. So I agree with you up to a point. It's a little bit trickier for the banks this year. But you know what, I think, you know, there's tremendous demand for credit. They have enormous spreads to play around with. The competition isn't that high because it's an asymmetric marketplace. I think, you know, from my perspective, I like those banks which are playing in the regional space. You've got the story of Uganda, which is 2.5 billion barrels of oil. You've got Southern Sudan, which still hasn't bedded down, but when it does will be very interesting as well. So I'm looking to play in those corners, very attractive PE ratios, pick up some cheap stocks, play the value game for a little while.